And obviously, it's even worse since the cerveza sickness. But where we were today, where we started here, is we've got prices going up by 50%. So if prices are going up by 50% during this time frame, what would have happened if you would have just had cash? Or you would have had it in a bank where they're paying you 5 basis points, even though Fed funds is at 5%. Well, you guys know the answer to this. You would have gotten crushed. So then you go into bonds. Okay, great. Well, there's times when you might make a real return, but that's if you believe the CPI. If you are a realist and you know that this understates inflation, most of the times you got a negative real rate of return on bonds. So your purchasing power is going down there. So what's your only choice? So your only choice is to speculate. Your only choice is to gamble on fart coin. Your only choice is to go out there and take massive amounts of risk. You say, well, George, Bitcoin isn't risk. Gold isn't risk. Yeah, it is. Yeah, it is. It is. I mean, over the long run, you can sit there and say, oh, it's very low probability that it doesn't go up with inflation. Okay, great. That's fine. But during decade-long periods with gold, it actually went down. You lost purchasing power. So this forces people to go out the risk curve. And no matter how safe you think Bitcoin is or gold, it's not as safe as having cash just in your back pocket or cash at a bank just making 5%. I'm talking about in real terms, right? That's the safest of the safe of the safe, right? So you see what this does is this basically you're forced into a position where you have to make at least 10% per year or 8%, 10%, whatever you think the inflation rate is, just to break even, just so your excess productivity, which at the end of the day is what savings is, just so it doesn't lose purchasing power and you don't just get poorer and poorer and poorer and poorer the more money you save, right? You have to go to the casino. And then we just have to hope that buying the dip works for the rest of eternity. But let's look at that. And let's look at the math there, because everyone thinks that, oh, George, this is not a problem at all, because all you have to do is put your money in the stock market, and it'll keep up with the rate of inflation, or you'll grow your wealth, you'll increase your purchasing power. So although these dynamics are at play, it doesn't even matter, because you're just going to have your 401k and you're going to be in the S&P 500, and Big Daddy government is going to make sure the S&P 500 never goes down, and therefore it's like your retirement plan, right? And actually, I'm skipping ahead here. Let's get into this in a moment, but before we do, I want to go back to the punchline here, because what is the difference, guys, between the 2000 to 2020 and 1880 to 1900? What's the difference? Why is it that we saw a bigger increase in the money supply during the 1800s, but yet prices went down by 20%? And during this time frame from 2000 to 2020, prices went up by 50%. The answer is this, in my opinion. And it makes sense, because back in the 1800s, the private sector, meaning the non-DMV, the efficient, the portion of the economy, the entities, the humans, the average Joes and Janes that are out there producing stuff, producing goods and services, that's 95% of the economy. So is it any surprise that if money supply went up by 250, that the amount of stuff went up by 300%? No, that's no surprise at all, because the private sector was 95% of economic output. Now, is it any surprise today that at 50% that we're not as productive? We're not producing as much stuff as we were in the late 1800s. Therefore, if you have the exact same increase in money supply growth, you're nowhere near as efficient. Of course, prices are going to go up. Of course. And this is without the Fed. This is without their balance sheet. This is without, even looking at the debt, because at the end of the day, the government spending isn't necessarily the debt, right? This is why we have to focus on government spending. You see, and said another way, if we look at history, then we can come to a pretty safe conclusion that the more this number goes up, like we were talking about going to 75% before, the more this number goes up, it's going to increase the need to go further and further and further and further out the risk curve. In other words, the more this number goes up, the closer we get to communism, the higher the overall inflation rate is going to be, because we're going to have less stuff. Even if we don't have more money, it's still less stuff. So you have this kind of ongoing supply shock, effectively, right? Which is going to put you in the exact same position where you're going to, if you don't take more and more risk, if you don't go out there and buy fart coin, if you don't go out there and try to buy, Trump coin or some, you know what's, Josh, did you hear about this thing with the WNBA, the WNBA?
I have no clue. Sorry, I don't follow it.
You know what the WNBA is, right?
The women's basketball.
Women's basketball. Well, they had this kind of, they had to stop a couple games like last week because some people were throwing a green. You guys know what I'm talking about. A green adult toy. We'll try to keep it kid friendly here. People were throwing green adult toys out onto the court, and then they would have to stop the game. And then this, of course, would make ESPN and it would make the news and everyone would be talking about it on social media, right? Do you know why they were doing that?
No clue.
Because they came out with a crypto coin, the green adult toy crypto coin.
The WNBA did?
No. The pump and dumpers. The pump and dumpers created a green adult toy coin, and to pump it, they threw green adult toys on the NBA court because they knew it would make the news and everyone would be talking about it. And then all the people go over there and say, "Oh, there's a green adult toy coin. Buy." That's where we are in the United States today. That's where we are. Why? It makes perfect sense when you look at this chart. And when you compare that to this, because people, now I'm not making any excuses for this, because unethically, I think this is disgusting what they're doing with these pump and dumps. But I get it, because people are put into a choice where this is the only way they can keep up with inflation. This is the only way they can even maintain their purchasing power. And unfortunately, guys, it's going to get worse. It's going to get worse. Now, I can't even Josh, what was I talking about? I skipped back. Now I'm going all over the place here.
I think that people need to go further and further up the risk curve to get a return.
Yeah, I know that, but I was going over something else. It doesn't even matter, because this is really what you guys need to know. It's if you believe this going higher is inevitable, you also must believe that it's going to be harder and harder and harder to maintain your purchasing power, and people are going to be required to do something. You cannot put your money in the bank. You cannot put your money in the stock market. Oh, that's what I was going to say. I reminded myself here. So now the argument that we were talking about, the pushback that you'll get is, oh, just put your, Dave Ramsey. Oh, just put your money into a 401k. Because we know that over time, stocks always go up. They always go up. They always go up. This is total nonsense. This is the most intellectually dishonest or lazy argument I have ever heard in my life. Let me show you what I'm talking about. This is a chart of the S&P 500. And what I want to do is let's just go all the way back here. So we're going back to, call it 1928. Now you'll notice, you're like, oh, George, but look at this. It just goes up all the time. Well, it's true. Just buy the dip and it always goes up. Right. In nominal terms. But what we're talking about here is maintaining your purchasing power, or hopefully even growing your purchasing power, so you're increasing your standard of living. So what we have to do is we have to adjust for the rate of inflation. Now, what we're going to do is we're going to adjust for the government's rate of inflation, which we all know is understated. Tells a little bit different story here, doesn't it? So if you were to buy stocks in 1928, let's say 1930, just to make the math easy, right? And let's say it's 452 or whatever. That's what the S&P 500 was when you adjust for inflation. And you held that for 50 years, 50, you would have lost money. The S&P 500 adjusted for inflation in 1928 was 452. We fast forward to the recessions of the 1980s, early 80s, and you can see right here, 374. And that's if you would have held for 50 years. So this idea that all you have to do is put money in the S&P 500 in an index in your 401k, and you're somehow going to just beat inflation, and this is going to be your retirement fund because you're going to be so rich and you're going to increase your standard of living to where you don't have to work. That's complete nonsense. All what that does is that simply looks at 1980 to 2000, and then it ignores 2000 to 2010, and then it looks at 2010 to 2020. And then, so it takes 20 years, or excuse me, it takes 30 years out of the last, let's call it 100. So out of the last 100 years, it takes 30 years, and that's what it builds a narrative around. That because something happened 30% of the time, we should just assume that it's going to happen indefinitely into the future, forever. I mean, would anybody in their right mind make that argument? No. It's stupid. It's like I said, it's intellectually lazy. Well, at the very least, it's intellectually lazy, and probably worse, it's just intellectually dishonest, because it's not like this chart that I'm looking at is some sort of proprietary information. This is right there on the internet. Anybody can access this stuff, right? And so then you say, oh, well, you switch back between this and bonds. No, you look at that 60-40 portfolio, and sometimes it works, sometimes it doesn't. I mean, we look at the 10-year. Now, I'm looking at this. Now, again, if we go into a recession, are you probably going to make a capital gain at the long end of the curve? Probably. And, do I think interest rates will probably lower in a year? Sure. But that doesn't mean over the next, between now and 2030, I think interest rates are going to be lower, because they do. They go in cycles like this. You guys know this. So even if the 10-year goes back down to 2, which I think it probably will, or it could, that doesn't break the trend. So say we're on this trend now, where interest rates are just going higher and higher and higher, even though we do have periods, long periods of time, where they go down. But interest rates go higher and higher and higher. Okay, fantastic. Well, what was the stock market doing back then? So let's look at that. The stock market between, well, we just did, but but you guys know the punchline here. We look at the stock market. Okay, so let's go to what was that? 1960 or so. So if you would have been in stocks in 1963, yeah, I mean, if you would have got lucky and sold at the right time, you would have made money. But if you would have just held, through that bear market in bonds, you would have gotten crushed. You would have gotten smoked. you've got destroyed on your bond position, and you would have gotten destroyed on your stocks. So this 60-40 nonsense that, oh, this all-weather portfolio that you just 60% stocks and 40% bonds, and if the stocks go up, you have this this equilibrium and this hedge. It's excuse my French here, but it's straight bullshit. It's straight bullshit. What they do is they just cherry pick certain times in recent history and extrapolate that indefinitely into the future. So now that we understand the problem here, and I think we can all agree that it's inevitable. I mean, when you look at that chart of government spending as a percentage of GDP, I don't know anyone that thinks by 2030 that's going down. Or I don't know anyone that thinks that if we don't have a recession, that's not going straight to 65 or 70%. And then when you include the ramp in government spending as projected by the government, then that takes us to 75% real fast. And if we can safely conclude that as a result, we're going to see higher rates of prices with the same amount of money growth, and that's going to push people further and further out the risk curve, that means that there's a lower probability that you maintain your purchasing power with your savings or your excess productivity. So what do you do? What do you do? I think you've only got one choice. You have to look at portfolio construction, and you have to understand how to, over the long run, put the odds on your side of making over, let's say, 10% in order to increase the purchasing power of your savings, right? And so this, what I did is I put a link in the description for the Rebel Capitals Pro that I have with Lynn, Chris, Brent Johnson, Lynn Alden, Chris McIntosh, Brent Johnson, Patrick Seresna, Jason Hartman. If you want to check it out, you can. I think Josh just put it there. But what we do, well, that's the school link, Josh, not that one. The one, just forget the school link. Just go over to the one that I put in the description of the video. So what we do over there, here's the bottom line, is we look at not only things that are cheap. I talk about that all the time. You buy things when they're cheap. You sell them when they're expensive. But you also have to have a catalyst. I mean, Jim Rogers teaches us this. And then you look at what I call a portfolio matrix. There's really only 3 levers you can pull in your portfolio. Number 1 is your win rate. So what we're doing in Rebel Capitals Pro is we're trying to go over picks from Lynn's portfolio and Chris's portfolio as an example to help our members increase their win rate. That's number 1. But you're only going to increase your win rate so far, right? You're never going to have 100%. I mean, let's remember Stan Druckenmiller's win rate's 55. So then the other lever you can pull on the opposite end is the number of bets you make per year. Well, because then what happens, you have the law of large numbers on your side, like a casino. But the odds of the average retail investor, making more than 10 trades or 10 investments per year, it's very unlikely. It's very unlikely because you've got other things to do. You got to live your life. So really the main lever that you have to focus on, whether it's in Rebel Capitals Pro or not, is asymmetry. You have to get good at cutting losers and riding winners. You have to get good at that. Because if you don't, I can tell you what your future is. And your future is your standard of living is going to decrease. That's your future. Because the only way that you're going to be able to beat the S&P, or you're going to be able to make more than what the cost of goods and services are going up over the long run, is if you get really good at that one lever that you have the most control over. And that's asymmetry. That's the bottom line. And this is what we really harp on in Rebel Capitals Pro. And that's why mentorship, you have to get some mentorship if you don't understand how to do this, whether it's with Lynn Alden, Chris McIntosh, whether it's within Rebel Capitals Pro or not, you got to do this. Or else, like we said, it's a foregone conclusion. You're not going to be able to just save money, just produce more than you consume and expect to retire if you're even 30 or 40 years old right now. It's very, very unlikely. And you can't just park it in the S&P. You can't just do the 60-40 thing. That's not going to work either. And if you just go all in with gold, all in with Bitcoin, that might work. But now you have no diversification whatsoever. And maybe it works out, maybe it doesn't. But the only way that you can really get the odds on your side is if you do what we teach people to do and what we help people do in Rebel Capitalist Pro, and that's higher win rate, asymmetric bets, and you're still making, let's just say 10 to 15 trades or investments per year. So if you want to check it out, you can. But the bottom line and what this video is all about is you guys have to be cognizant of this. You have to be cognizant of, and no one really talks about it. We talk about the economic crisis like a financial crisis or something like that, or the stock market going down by 30 or 40%, or housing. We didn't even talk about housing. That's in a massive bubble as well, just like the S&P 500. So it's not like you can park your money in that and expect to increase your purchasing power over time. So you have to be aware of the fact that this is the direction we're going. We're headed towards socialism. We are headed towards 75% government spending as a percentage of the economy. We just are. Now, whether it comes in 5 years, I think it probably will, or sooner or later, I don't know, but that's the path we're on. So you've got to be aware of this stuff, and you've got to prepare for it now. And the people that prepare for it will have opportunities, and the people that don't, unfortunately, will see their standard of living decrease, just like we saw in other crisis periods throughout history. And it might not be a result of a massive deflationary bust like we saw in the Great Depression or hyperinflation due to Weimar Germany. It will be just the constrictive nature of government spending just pushing out the private sector and making it's like death by 1,000 cuts. And we're going to wake up one day and we're going to look back at communist Russia, and we're going to, as Americans, and we're going to say, damn, why are we having all those exact same problems? And the reason is because that chart that we went over at the beginning of the video. All right, guys, check out that link in the description if you want. We do the live streams over there. We talk about this stuff, and but whatever you do, just make sure you're aware of this stuff, and make sure you're standing up for freedom, liberty, free market capitalism, and we'll see you on the next video.